Hello, colleagues. This is Lakshman here. So I'm here to give you a 10-minute summary of a paper that I'm working on these days. It's not complete; it's a work in progress. So let me explain what we have done so far and what remains to be done. So these about the relationship between conditional returns and downside risk. So let me explain that because downside risk is a bit different from conventional risk in finance because it comes from behavioral finance, which was popularized by Kahneman and Tversky in prospect theory. So in behavioral finance, investors are supposed to be loss averse and not risk averse, as in conventional finance. Risk aversion means there is a symmetrical variation in returns, but loss aversion means that they are more concerned about downside losses. And so therefore, when there are securities with high downside risk, they will demand a greater reward. And another way that you can have downside losses is with securities that have negative core skewness. Okay, right. So we use these two measures to estimate downside risk. So we have the negative beta, which is beta conditional on market downturns, as you can see here. And then we have co-skewness that we calculate with this formulation, which is the covariance with squared market returns. So we can summarize the way that investors behave towards these downside risk measures. So they will dislike securities with high negative betas, and they will expect high expected returns. And likewise, they will also dislike negative or low skewness securities, and so they will expect high expected returns for such securities. Then next, in this paper, we are looking at what's called conditional returns rather than just standard conventional returns. So these are conditional returns means returns that are conditional on whether the market is up relative to the average or down relative to the average. So in a paper that is that came in 1995, JFQA paper, these authors have popularized this approach, and we are going to make use of that approach to examine uh, uh, risk return relationship. So the objective of the paper is to examine downside risk and rewards in the US stocks within the framework of conditional returns, and we are going to look at the contemporaneous or within the same period risk reward relationships, and also the predictive ability of these risk measures to forecast future returns. And the expected contribution from this study is that we are, by looking at these conditional returns, we expect to give a much clearer picture of risk and downside risk return relationship, particularly these two measures alongside each other in explaining rates of returns in the US stock markets. So this has not been done previously, and we expect that to be a positive contribution from this study. Okay, the data that we are using is all the constituent stocks of the Standard and Poor's 500 index, which are the largest stocks in the NYSE and the Nasdaq exchanges, and we are going to use a 10-year sample period from 2010 to 2020, and this data was obtained from DataStream. The methodology we are using is what is called the Farmer and Macbeth two-pass regression framework. So in the first pass, we measure risk measures like the negative beta, the co-skewness, and market beta using time series regressions over 12-month horizons using daily returns. And then in the second pass, we separate the sample into up markets and down market periods separately, and then run cross-sectional regressions to look at the contemporaneous relationship between risk and returns, and also the predictive relationship between risk and returns for our sample. So the preliminary results that we have got are quite interesting, because we see that there is a very clear reversal or change in the signs of the coefficients of the different risk measures, the beta, the negative beta, and the co-skewness coefficients between up market periods and down market periods. So we find that downside beta is negatively related to returns in down market periods, and the opposite in up market periods. The co-skewness coefficient is positive, on the other hand, in down market periods, and take the opposite sign in the up market periods. Then looking at the year ahead predictive results, we see the similar kind of distinct difference in the relationship between up market periods and down market periods. So the signs of the co-skewness coefficients and the negative betas and the betas switch between up markets and down markets periods. And we also find that when we look at the up market periods separately from down market periods, we see this significant relationship which is not observed, or it's obscured, when the full year period is examined without conditional returns being examined. So that's interesting. What are we concluding from these results? Well, we have to find some further answers before we can form some conclusions, because we need some answers to cover ourselves, because before we send it to a journal, because as you know, these referees have a way of throwing difficult questions at you, so we need to find answers and tie up all the loose ends before we send it off to a journal. So questions such as why are the signs of the downside betas and co-skewness different to each other, and why do they switch between up periods and down periods? Is it because these risk measures are capturing different aspects of risk? And again, is it because of different levels of market volatility during up periods and down periods? Because co-skewness is something to do with squared market returns, which is something to do with volatility. So these are questions that we need to find answers to. So we need to dig further and do some further tests before we can conclude our paper. So that's where we are at, and hopefully we can complete these investigations within the next couple of weeks or months, and then hopefully send it off to a decent journal to get our responses from the referees. So thanks for listening. So I'm ready to answer any questions if you have any. Thank you.